Hello everyone. Now let's continue our discussion about absorption costing and variable costing by doing an analysis of operating income using both costing methods. So let's see this example. Assume that Fran Manufacturing Company has no beginning inventory and sales are estimated to be 20,000 units at $75 per unit. Also assume that sales will not change if more than 20,000 units are manufactured. So in other words, if we manufacture more than 20,000, that would stay as ending inventory. So here we have two proposals. Proposal 1, where we have 20,000 units to be manufactured and sold. And here we have the manufacturing cost, variable and fixed, based on 20,000 units of production, and these are the unit cost, and that's the total cost. And then we have selling and administrative expenses. And again, the same thing for 20 units. And here's the total cost. And for the variable cost, we calculated the unit cost to be $5. So that's the first proposal. The second proposal, we are assuming 25,000 units would be manufactured. However, as we said, 20,000 units will be only sold. So the remaining 5,000 would be ending inventory. So here, based on the number of units, which is 25,000, the manufacturing cost, variable and fixed, will be these values. And the selling and administrative expenses will have 100,000 for each, and the unit cost would stay 5,000. So let's compare here the fixed cost under the 25,000. You can see it was under 20,000, it's actually $20 each, but under the 25,000, it went down to $16 because we have the fixed value, but we're divided it by more number of units, so now it's 16. For the selling and administrative, it's still 100 and 100, which is based on $5, but the total numbers, because we're only selling 20,000, it's not going to change. So we still have 100 and 100, 100 for variable and 100,000 for fixed. So now let's see through this exhibition the absorption costing income statement for two production levels. We have the first column, we have the 20,000 units manufactured. The second column, we have the second proposal where we have the 25,000 units manufactured. So remember, here we're using the absorption costing, so the sales would be our very first line, 20,000 units at $75, and remember we said the sales are going to be fixed, whether we produce more or less. If we produce more, the extra units manufactured would stay as ending inventory. So our sales are going to be based on the 20,000 units. So $75 each, that would be 1.5 million based on the two proposals. Remember, under absorption costing, we have two important numbers that we think about. We have to calculate the gross profit and we have to calculate the operating income. So to get the gross profit, we have to subtract the cost of goods sold from sales. So how we get the cost of goods sold? We have to get the cost of goods manufactured, and we subtract the ending inventory. Under proposal 1, we don't have an ending inventory, so we get the cost of goods manufactured, which is 20,000 multiplied by 55, which is 1.1 million. Then we subtract ending inventory, and as I said, we don't have ending inventory. So the total cost of goods sold would be 1.1 million. We subtract it from sales, we get gross profit of 400,000. Then we subtract the selling and administrative expenses, which were the 100 and 100, which is a 200, 100 fixed and 100 variable, or 100 variable and 100 fixed. That's 200,000, and the operating income would be 200,000. Under proposal 2, we still have the same sales, 1.5 million, but we actually produced more. We produced 25,000 at $51 each. That was 1.275 million. Then we subtract our ending inventory. Remember, we produced 25, but we only sold 200,000. So we have 5,000 units left at $51 the cost. That's 255. That would make our cost of goods sold 1,020. We could have done it in a much more straightforward way, which we just get the 20,000 units at 51. But again, I think this is better because you see how much manufactured, and you subtract the ending inventory, because sometimes when we have a beginning balance, the cost would be different. So the gross profit in this case is 480. We still subtract the 200,000, 100 fixed and 100 variable, and that's 200,000 out of the 480, then our operating income in this case is 280,000. So notice, even though our sales are the same under proposal 1 and proposal 2, but when we produced more than what we sold, we end up having higher operating income under the absorption costing. And why is that? Because ending inventory absorbs part of the fixed cost. And that way it gives us a chance to increase our gross profit and our operating income. So managers should be careful in analyzing operating income under absorption costing when finished goods inventory changes. So we've just seen a clear example here when finished goods were over the sales. In this case, our profit was higher, but we need to be careful about that. So increases in operating income may be created by simply increasing finished goods inventory. Therefore, managers could misinterpret such increases or decreases in some cases in operating income as due to changes in sales volume, prices, or cost. So managers need to be careful about that. So in the example that we just had for a friend company, under variable costing, operating income is 200,000, regardless of whether 20,000 units or 25,000 units are manufactured. This is because no fixed manufacturing costs are allocated to the units manufactured, and all fixed manufacturing costs are treated as paid expenses. So now let's see the variable costing income statement for 3 production levels. Actually, we added 30,000 units as a third column, which is not going to make a big difference because see here, the operating income at the very end, we still have the same values, 200,000, 200,000, 200,000. And that's why, because we are using the variable costing. We're not using absorption costing. In absorption costing, the more you produce, the higher your operating income, even though when you don't sell all the products that you produce. And that sometimes can be tricky because managers might be tempting to produce more and more and more just for the sake of absorbing part of the fixed cost with the inventory for future periods. So I just want to show you here that the steps we have under variable costing, we have the sales, which is the same, 1.5 million. We have 20,000 units at $75 each. We subtract the variable cost of goods sold to get the first thing, which is the manufacturing margin. And again, here we have the variable cost of goods manufactured minus the ending inventory. Remember, in the 20,000 units, we had no ending inventory. And in 25 and the 30,000 units, the ending inventory has increased. But that did not change the variable cost of goods sold. The variable cost of goods sold stayed the same. And of course, the manufacturing margin stayed the same. And that was the first step. The second step is to calculate the contribution margin. And the contribution margin is calculated by only calculating the variable selling and administrative expenses, which is only 100,000 in each case. Then the last part, after we calculate the contribution margin, would be the fixed cost. And here we have the fixed manufacturing cost and the fixed selling and administrative expenses, the other 100, and we also add the 400,000 for a total of 500,000 in each case. That would lead to operating income of 200,000 in the 3 scenarios or the 3 proposals that we have. So this just gives us an idea that under variable costing, the number of units manufactured would not have an impact on your operating income. Now let's try to test our knowledge here. So when using absorption costing, increases in operating income may be created when? By increasing finished goods of inventory, decreasing finished goods of inventory, expensing fixed manufacturing cost, or expensing variable production cost. The last 2 are irrelevant, okay? This is not really relevant to what we're trying to see here, which is the increase in operating income, which is the bottom line number. So the bottom line number, as I said, is going to be impacted by the amount of manufacturing versus our sales. So if our manufacturing is more than the sales, that would lead to increase in the finished goods inventory and increase in profits. So when using absorption costing, increase in operating income may be created by increasing finished goods inventory. So the right answer is A. Managers should be careful in analyzing operating income under absorption costing when finished goods inventory changes. Increases in operating income may be created by simply increasing finished goods inventory. And that's a little trick that, again, as I mentioned, managers can rely on as a way of showing better income numbers just by increasing production, even though they know that the sales is not going to absorb all this kind of sales, this manufacturing that they're making. Now let's talk about using absorption and variable costing, how we can use it. So each decision-making situation should be carefully analyzed in deciding whether absorption or variable cost reporting would be more useful. The use of absorption and variable costing in the following decision-making situation would be elaborated in more details. So we have things like controlling cost, the pricing products, planning production, analyzing market segments. So we'll talk about each one of these. We're not going to go into a lot of details, but just to get the idea. So again, one more time here, using this exhibit. So accounting reports and management decision. So absorption costing and variable costing here. We start with the accounting report. Management would need to make the decision based on these factors. How we can control the cost, the pricing of the products, planning production, and analyzing market segments. So remember these 4 points because we're going to elaborate on the impact of absorption costing and variable costing based on these 4 factors that affect management decisions. We can think about it the other way. We can think that these four elements would have an impact on management decision on how they're going to use absorption costing versus variable costing. So let's start with the first two, controlling cost and pricing products. So for a level of management, like a specific level of management, controllable costs are costs that can be influenced, in other words, increased or decreased by management at that level. Keep in mind, in any business, there are many different levels of management, and each manager or each level of management would have the ability to control the cost at that specific level, but not the other levels, especially the higher levels. You cannot control much on the higher levels. So you can increase it and decrease it only at your level. The things that you cannot control are called non-controllable costs, and these are controlled by another levels of management. In most cases, it's the higher level, but again, possibly also on a lower level. Variable manufacturing costs are controlled by operating management. So that's very typical. Like operating management are the ones who can control the variable manufacturing cost. Fixed manufacturing overhead costs, such as the salaries of production supervisors, are normally controlled by the higher level of management. Because fixed costs cannot be avoided, keep in mind, fixed cost is a fixed cost. You have to pay. It does not change with the number of production. The selling price of a product should be, or should at least be, equal to the variable cost of making and selling it. So when we are deciding on the selling price, we need to make sure that we are at least covering the variable cost. And anything that we make extra would be helping and covering our fixed cost and maybe generating more profit. So as it says here, any price above this minimum selling price, which is the variable cost, contributes to covering the fixed cost and generating income. Now let's talk about planning, production, and analyzing market segments. So in the short run, planning production is limited to existing capacity, and operating decisions must be made quickly before opportunities are lost. So in the short run, again, we cannot really make a lot of changes in our production plans. It's only limited to our existing capacity. So let's say our capacity is between 10,000 to 15,000. We cannot really change our plans to start producing 50,000. Our range is only between 10 to 15,000. So to increase it to 50,000, that's something that would require some more time. So in the short run, again, planning production is only limited to existing capacity, and operating decisions must be made quickly before opportunities are lost. The relevant factors for such a short-run decision are the additional revenues and the additional variable costs associated with the order. So we only focus variable cost and how much revenue we're generating. We really don't think too much about the fixed cost. On the other side, in the long run, planning production can include expanding existing capacity, like having a new factory, hiring more people. So in this case, when analyzing and evaluating long-run sales and operating decisions, absorption costing, which is considered fixed and variable cost, is often more useful. So this is where absorption costing would be considered. So market segment, on the other end, is a portion of a company that can be analyzed using sales, costs, and expenses to determine its profitability. So usually a business would divide its operations into different market segments. So example of market segments include sales territories, products, salespersons, customers. So this is how companies would break down their sales, for example. So it could be by area. So we're going to be seeing an example for Apple. So they have domestic sales versus international sales, or Amazon, the same thing. Products, it could be iPhones versus laptops and the MacBooks and stuff like that. Or could be other products. The salesperson, we can have like different salespeople, and each one would be taking care of a specific market. It could be also the customers, okay, like customers based on like younger generation versus older generation, or different kind of customers based on many different demographics. So now let's try to test our knowledge here by seeing this multiple choice question. Which of the following would not be considered a market segment that a company could use to analyze profitability? Could it be the salesperson? Could be regional offices? Could be production cost? Could be customer demographic group? Again, I think we talked about salesperson, we talked about regional offices or different areas. Production cost, I don't think that's something related to market segment. How about customer demographic groups? We just talked about that. So I think the only answer that does not really belong to that, would not be considered a market segment, is the production cost. So C is the right answer, or the only wrong answer out of the four. So market segment is a portion of a company that can be analyzed using sales, costs, and expenses to determine its profitability. Examples of market segments include sales territories, products, salespersons, and customers, as we mentioned. Alright, so let me stop here. In the next video, we're going to be talking about analyzing market segments.